If you think you need hundreds or even thousands of dollars to start investing, let me stop you right there. Because today, I'm going to show you how you can start investing with just $10. Yes, only $10. And trust me, this small start can completely change your financial future. Welcome back to the Passive Path, where we make money simple, smart, and accessible. Most people delay investing because they think they don't have enough money. They're waiting for that big bonus or a huge savings account. But the truth is, you don't need a lot to start. You just need consistency. Think about it. Even $10 every week or every month can grow into thousands over time, thanks to the magic of compound interest. It's not about how much you start with. It's about starting early and staying consistent. Small money invested early grows big over time. The key is to let your money work for you, and the sooner you start, the more time it has to grow. So, where do you begin? Step 1 is choosing the right investment app. You need a platform that's beginner-friendly and allows you to start small. For my viewers in the USA, I recommend checking out apps like Robinhood, Fidelity, Acorns, or Webull. They're all designed for ease of use and have very low or no minimum investment requirements. If you're in the UK, great options are Trading 212, Free Trade, and Revolut. And for my friends down in Australia, look into CommSec Pocket or Raise. What makes these apps perfect for a $10 start is a feature called fractional investing. This means you don't have to buy a whole, expensive share of a company. Instead, you can buy a small piece of fraction of a big stock like Apple, Amazon, or Tesla, even with just $1 or $10. This makes the world's biggest companies accessible to everyone, no matter your budget. Now, for the big question, what should you actually invest your $10 in? With a small amount, you want to avoid taking huge risks. Don't go chasing after some speculative, risky stock you heard about online. Instead, start with safe, beginner-friendly options that are built for long-term growth. Your first and probably best option is to invest in ETFs, which stands for Exchange-Traded Funds. Think of an ETF as a basket that holds hundreds, sometimes thousands, of different stocks. This diversification automatically reduces your risk. Instead of betting on one company, you're investing in a broad section of the market. For beginners with $10, some of the best ETFs are ones that track the S&P 500, which is a collection of the 500 largest companies in the US. Look for tickers like VU from Vanguard or IVV from iShares. Another great choice is a total stock market ETF like VTI, which gives you a piece of the entire US stock market. Your second great option is an index fund. These are very similar to ETFs, and their goal is to simply mirror the performance of a market index like the S&P 500 or the total stock market. They are low-cost, diversified, and have historically provided solid, reliable returns over the long run. It's a set it and forget it kind of investment, perfect for someone just starting out. And your third option is to buy fractional shares of big, established companies you know and love. If you're a fan of Apple products, use Google every day, or shop on Amazon. You can invest directly in these companies. Instead of needing hundreds or thousands of dollars for a full share, you can buy $5 worth of Apple or $10 worth of Microsoft. This way, you can own a piece of the companies that are part of your daily life. It's a great way to feel connected to your investments and learn as you go. Once you've decided what to invest in, the next step is crucial. Automate it. This is the secret weapon of successful long-term investors. Go into your chosen app and set up an automatic investment of $10 every week or every month. This simple action does two powerful things. First, it removes emotion from the equation. You won't be tempted to skip an investment or try to time the market. Second, it builds wealth consistently through a strategy called dollar cost averaging. This just means you're investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. Sometimes you'll buy when prices are high, and other times you'll buy when they're low. Over the long term, this approach smooths out your purchase price and is proven to deliver strong, steady results without the stress of market watching. Now that you know what to do, let's talk about what not to do. Avoiding these common mistakes is just as important as the positive steps you take. First, don't invest in get-rich-quick schemes or volatile crypto coins promising overnight wealth. These are often closer to gambling than investing. Second, don't blindly follow random hype from influencers on social media. Always do your own research and stick to your long-term plan. And finally, a golden rule: don't invest money you need immediately for rent, bills, or emergencies. Investing is for the long term. Your focus should be on building sustainable wealth over years, not chasing short-term thrills. Let me show you a real example of how powerful this is. Let's say you invest just $10 a week into an S&P 500 ETF, which has historically returned about 10% per year on average. After 10 years of this simple habit, your investment could grow to between $7,000 and $10,000. After 20 years, you could be looking at over $25,000. And after 30 years, that small $10 a week habit could compound into $60,000, $80,000, or even over $100,000, all from just $10 a week. That is the incredible power of starting small and staying consistent. So remember, starting small is infinitely better than not starting at all. That $10 might not seem like much today, but trust me, your future self will be incredibly grateful that you decided to begin now. Take that first step. If you found this helpful, please give the video a like and subscribe to The Passive Path for more simple, smart money advice. And let me know you're ready by commenting below. I am starting today. Thanks for watching.